Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm giving you your weekly housing market update. And we're going to be running through a few things today that I think will help keep you up to date on what's going on. Please make sure that you share this with your friends and family who might be interested in what's going on in the housing market. Be sure to follow us on or subscribe on YouTube and also on Facebook and Instagram, and we're even starting to expand out to some other platforms like Rumble and whatnot. I haven't started doing a podcast yet, but we'll get there. We'll get there. All right, guys, let's go ahead and get this out today, and we will kind of give you an idea of what's going on in the housing market and how things are shaping up, and what the real story is on things from the national and local level, mostly though here in Phoenix is what we try to do. So right off the bat, I'm going to kind of set the stage here with where we are in the market. And the Fed rate hike, which we had already talked about last week, was coming, and it happened. And U.S. GDP fell 0.9% annual rate in the second quarter. Recession fears looming over the economy. Of course, we know technically we are in a recession. You can try to redefine it, but two quarters of negative growth puts us in a recession. It's the way it is. And we can go back and forth on that all day long if you'd like. But, some people want to try and redefine it, and that's where we're at. So June core PCE signals inflation remains an unacceptable level, former Atlanta Fed president says. And we see that the more, he says, the more the more encompassing headline figure rose 6.8% on an annual basis, hitting a fresh 40-year high as gas prices surged while inflation jumped 1% from May to June, tying its biggest monthly gain since 1981. So, obviously these are all, recessionary factors. And then the other thing I wanted to point out to you was, even though we had the Fed basically, raising the interest rates. And again, that's not just on mortgages. It's basically, in a nutshell, kind of down. And anytime you're going to be using a credit card or borrowing money, for a line of credit or on mortgages, it's going to cost more to do that. A lot of this for the housing market was already baked in, as I mentioned, the last couple of weeks. And so the past week, though, we saw that interest rates actually kind of went down for the mortgage average. Again, this is the average of all different type of loans out there, was 5.3%, down from 5.4% the week previously, according to Freddie Mac reporting. And a year ago, though, the issue was that the interest rate was 2.8% during the same period. So obviously, that is causing an issue with our demand, which we'll get into more. And we did get a surge of, which is typical whenever we see fears of a recession coming up. It's typical when we see interest rates go up because of inflation. A lot of people want to just try and unload because they think, oh, market's going to level off, which it is. Again, but like anything else, real estate is long term, and our appraised values aren't really changing. It's just we've got more of a surge of properties coming on the market, especially at the lower price levels across the board, across the country, and in the Phoenix market. So we're seeing that the overall averages for some of the sales prices have gone down overall, but it's not that your home specifically, your appraised average value has gone down. So let's kind of dig into this a little bit more without getting too far into the weeds. Just to kind of give you kind of a quick idea of what's going on with the market. We can always give you more information if you'd like to know more about what's going on in your specific subdivision and city and zip code and those sorts of things. Because where we are now is 35 days closed on market. Now that's up a few days even from last week. That number used to be much lower just a few weeks or months ago. We were, at certain points, we were, down near 20. That's closed days on market. That's not just going under contract. So, properties are sitting longer because there's a little less demand due to the higher, not only higher prices, but higher interest rates. You go from 2.8% up to 5.5, then down to 5.3. We see that what that does is, if you kind of know how it works, is for every 1%, so you go from 2.8 to 3.8, or and then up to 4.8 and beyond. For every 1%, that is about 10% more in a payment for you. So that's less buying power for you. Keep in mind, if you have solar on your house, that has to be figured into somebody's max loan amount, what they can afford. I always bring this up, it's around $50 to $60 for every, so for every, let's say on an HOA that also has to be figured in, or on a solar lease, it's about, every 50 to 60 bucks takes away on those things. If there's $50 HOA and your solar lease is $50 a month, that's $100 that has to be figured into that person's loan. Just as an example. So right there, for about every 50, 60 bucks that we have to figure those type of things into somebody's total cost, okay, that takes, for every 50 to 60 bucks on those sorts of things, that takes away $10,000 from what the person's max qualification will be. So now if you're qualified for a $500,000 loan, and somebody has a $50 HOA and a $50 solar lease, now on your house, of course, they figure in taxes and insurance. That's just a given. Taxes, insurance, you're in the interest rate, obviously, and then the principal. But these are just other things that have to be figured in. And I bring this up because it's about affordability, right? It's why the demand has dropped. These are just things you have to be aware of when you're listing your house, so you price it accordingly. So now, instead of that person qualifying in that example at 500,000, now they're qualifying for 480, just to use round numbers, okay, give or take a hair there, okay. It's not the exact numbers, but that's about what it would shake out to be. And yes, you figure in the other PITI, basically it's called, principal, interest, your taxes and insurance, and then HOA, if there is one, homeowners insurance or homeowners association fees, and then your solar lease if you have one. So these are all things that when we're pricing a home, we have to be aware of, especially in a slower market. Back 4 or 5 months ago, it wasn't as big of a factor when you have those extra things that have to be figured in, because we had this huge influx of people coming in California and other places buying up cash and having all the money in the world. So anyways, we can get into that when pricing homes more in detail with your properties, but we're at, definitely things have slowed down a little bit, kind of leveled off, okay, which is more of a normal market though, more of a normal balanced market. And then we were at just over 3 months supply at 3.02. So again, we're active properties were at 18,600 when we pulled this together this week. So that's still not quite a full supply, even at that point. More of a completely across the board balanced market for us in the Phoenix area would be more like 4 to 6 months supply, 4 to 6 months supply. Now, this 3 month supply though is pretty healthy in the sense that more of a balance, getting towards more of a balanced market, into a buyer's market in some areas of the city. Again, we're only dealing with round averages, and then we kind of break it down more when we get into the Cromford Market Index here, which I'll get to in a minute. So we're just over 3 months supply, 35 days on market. Absorption rate is 33.14%. That's not super fast like we were before, but it's certainly a brisk market in general terms. So the Phoenix market's doing well. And then we've got 709. 709 is the average list price, and the average sales price is 547,000. Again, those are just averages across the board. And the greater Phoenix area, taking into consideration all the cities in the greater Phoenix area in Maricopa County and Pinell County. So when we look at the list to sales price ratio, it's very healthy at 98.32. Okay. That means, it was just under 100% of whatever it was listed for, it sold for. So people are, buyers are getting some deals now. We were, well over 1%, in previous months, over the last year, in the previous months up until about, April, May-ish. We saw these, kind of leveling off of these numbers. Then we get to, again, active properties are up 2.3%. That's 18,600, as I mentioned earlier. Only 21 short sales, only 3 lender-owned REOs on the market out of all of that, and 0 HUD homes. 0 HUD homes. Okay, so your distressed market, it's almost non-existent when you look at the overall numbers. That's really hardly anything. We don't see Chicken Little, skies falling, market crash, housing bubble ain't happening. So new listings, came on at 2,278. That is a decrease of 9.8%. So a little bit less homes coming on the market. So maybe we're seeing a little bit of lessening of that surge. We talked about a little bit of that last week also. And then homes that are under contract are actually at 3,490. That is down from 6,164 just a month ago. So big difference there, and that's really what's driving it. We know that there's just not as many people in the market right now due to these inflationary factors and interest rates. So the price ranges from 0 to 499,000 are putting us at 49.92%. And again, that is the largest segment of the multiple listing service right now, which again, in that lower segment of new homes that are on the market or active right now, kind of brings down the overall average, okay, as opposed to some of the months past and the increase in inventory versus the low inventory that we had in months past. And then from 500 on up to 999,000, we're at 38.8%, and 1 million plus at 11.3%. So that average in the lower price point under 500,000 is at 44 days on market. 44 days on market. The 500 to a million is 47 days on market, and a million plus at 81 days on market. So all those numbers are still good. They're still healthy. They're just not as fast as what people were seeing before. And people are a little bit, what's going on? I'm worried. It's more of a normal market. It's more of a normal market, where we're seeing these things. That's why we get that average of 35 days closed on market. So now that we've kind of set the stage for what's going on there, let's look at the pending home sales and more buyers getting priced out, right? So that's kind of what's happening and what has happened. And when we look at some of these numbers nationally from the National Association of Realtors, these numbers, show us what's been going on. Homes are, basically 80% more expensive than they were in 2019. Okay. So the median existing home price again nationally hit an all-time high in June of $416,000. In the Phoenix area, we're sitting right around 480 for the median price. Again, that's the median price. And nearly the NAR says nearly a quarter of home buyers who purchased a home 3 years ago would be unable to qualify to buy a median priced home today with the elevated prices and of course the interest rates, right? Because again, we went from 2.8 and this past week we're at 5.3. So again, 2.8, that's 3.8, 4.8 plus, let's say 2.5% higher, right? Just to kind of use round numbers and so we can understand at the street level what's going on here. So that brings us to 25% higher monthly payment. Just the interest rates. I'm looking from 2019 to now, we've seen that home prices have gone up 80% across the board nationally. Okay. So again, a quarter, I'm going to stress that, a quarter of the home buyers who purchased a home 3 years ago would be unable to qualify today. Yes, people are getting raises and everything, but they're not quite keeping up with the inflation rate. And then you throw the interest rate on top of that, and the price of the inflated prices that went on due to the high demand and surge of high demand and low supply in the past, and puts us where we're at today. So there's an affordability factor, obviously. The sales rate, the actual sales rate is down 25% year over year, lowest for July since 2014. Okay, at 6707. 6707, and that's in the Phoenix market. I'm sorry, back to Phoenix market. And then new listings we took on, we talked about earlier, just in the last 7 days was 2589, and that is up 5.8% from a year ago. Okay, so these are obviously more supply, less demand, obviously brings us to where we are into more of a balanced market, a little bit of a slower market, not a crash. Your appraised values aren't going down. It's just the balancing out, the leveling off, and what's going on in the market shift. So the peak price was, I'm sorry, the peak of the new listings was 3169. That was on June 25th. That was the peak, 3169. So definitely down from where we were just in the last 7 days at 2589. That's 2,589, but up 5.8% from a year ago in new listings. Okay, but the peak was 3169 June 25th. Now the demand, let's look at that for a minute. We have 7887 under contract. So we're down 28% from a year over year standpoint. We're down 28%. So that's the lowest end of July since 2007. Okay, so there's definitely been a shift in the market, and just over time and over the last year or two, prices, 3 years total, along with interest rates, just have really put a hindrance on people, along with the overall economy, inflationary factors. It just costs 25% more, basically, to, when you figure in your cost for your food, your gas, and your groceries. I'm sorry, your food, your gas, and your overall utilities for your home. It's costing people about 25% more total in what they're putting out. Some estimates even have it as high as 32%. Let's kind of maybe go halfway in between there, let's say, and but conservatively 25% more. Okay, so just Phoenix proper, the city of Phoenix. Since we are looking at the metropolitan area, let's look at this, because this kind of expands out to every other area, since Phoenix is the metropolis here. And we've got monthly average sales price per square foot as of the end of last month. The peak, let's take a look at the peak in May, was at $323.83. That was the peak in May. All right. So we've had a decline since then of 5% in price per square foot. Again, using overall averages, seeing that surge of new supply, and especially in the lower price point under $500,000. Okay, and even under the median price we're at now at about 480. So so with Phoenix, that is Phoenix itself gives us about 25% of the entire market share. All right, that gives us 25% of the entire market share. And then when we look at the other cities such as Chandler, Glendale, Mesa, Scottsdale, and Sun City and Tempe, those cities have also seen a decline along with that. All right. So the biggest decline cities since the shift happened, in other words. So let's look at the CMI. Every week we go over this. It's called the Crawford Market Index, or the CMI. If anything over 110 on the index is in a seller's market, anything below 90 is in a buyer's market, and 100 would be dead center in that range. Okay, so looking at this CMI, we are right now at 126. So technically, overall, we are in a seller's market because we're over 110. But obviously, those numbers were in the high fours, up near 500, not that long ago. So when we look at the demand, this is the biggie right here. The demand and supply. When we look at this, this kind of gives us the idea of what's going on. We were up back near April or May, we were up near 120. Right now we're at 81.5 in demand. So our demand is down due to the factors we've already gone over and discussed with, supply, the interest rates, and the cost of overall purchase price. So the demand has gone down. The demand is below at 81.5. It's below the 90. So now that puts us in a buyer side of things there. Okay, as far as we're concerned. So it's actually down from that 100. If you look at 100 mark right in the middle, we're down about 18%. Okay, and then for supply, we're at 64.7. Well, there was a point where we were sitting forever and ever and ever at about 20 point whatever to about 21%, 25 on the supply index. So at 64.7, we're still below, well below where we want to be on supply. If we want to say dead center, we're at 30, let's say 35 below at 64.7. We're below that 100 mark by about 35. So if we break it down into the cities, we look at this, this is where all our issues are coming from as far as the market leveling off, for sellers. And we look at Maricopa City, Queen Creek, and Buckeye. Those are in buyers markets now. Those are on the CMI, on the Crawford Market Index. Those are in the buyer's market right now. So keep that in mind. If you're out there looking at homes, you can get some good deals. If you get ready to sell a house in those markets, definitely a big difference. Just not that long ago, these markets were, in this well into the seller's range. And then when we kind of break it down a little bit more, and we look at the overall average, and well, first of all, let's look at these cities here, from Peoria, Chandler, Surprise, and Tempe and Gilbert. Those are going to be buyers markets by mid August, and those first three I mentioned, Maricopa, Queen Creek, and Buckeye, those had an overall supply of 675. Now they're at 2143. Okay. By end of August, Mesa, Phoenix, and Glendale will be in buyers markets. Right now they're in balanced markets. And basically any of the cities I've mentioned here, Mesa, Phoenix, Glendale, Peoria, Chandler, Surprise, Tempe, Gilbert, Maricopa, Queen Creek, Buckeye, they either already are or will be in a buyer's market by the end of August. Okay. Right now, holding steady at 129 or higher is Goodyear on the market index, is Goodyear, Avondale, Cave Creek, Scottsdale, Paradise Valley, and Fountain Hills. Now, the overall last month of decrease in the CMI, or the Crawford Market Index, was 32. Okay, but before that, several weeks back, it was 34. So we're seeing that even though there's been these decreases, we're seeing that it's a much starting to go down in a very significant way. We're seeing kind of even a lessening of the decreases that we were seeing before, in a much faster way. So, as far as a crash coming and looking at the distressed properties and all the indicators that we look at to get into it, we're not going to see a crash anytime soon. Again, we're going to see kind of a leveling off, more of a balanced, healthy market for people. So just kind of hunker in if you're getting ready to sell a house. Now, I will say this: some of the just being in the market out there, working with buyers and sellers, if a property is kind of like that typical three with a den, four bedroom or larger, and it's priced well, let's say in $500,000 to $600,000 range or under 600,000. It's maybe already got a really good looking pool, great backyard, all the bells and whistles. Those properties are probably going to go under contract within a week or two versus that 35-day average. Okay. So in other words, that the houses that everybody really likes, and loves to see, like for the most part, that most buyers are looking for, that kind of have that look that you see on HGTV, kind of the trendy look, all the bells and whistles, don't have to do much to them, except maybe change some wall colors, even though it's already got a fresh, good neutral palette to it, and all those sorts of things that people are looking for that they can kind of maybe just tweak, play around with a little bit. Those properties are definitely selling a little bit faster. Okay. But even those properties, are maybe sitting around a week or two versus, so figure at least a couple of weeks, even on those, um, versus what we were seeing before, where we were going under contract and everything on average in about 7 days. Now, on average, going under contract takes about 3 weeks just to go under contract on average. Okay. That's what's giving us that 35-day average close days on market. So anyways, that's all I got for you this week. If you have any other questions about your local area, your particular property, what's going on there with the Crawford Market Index, or what's going on with your home values, strategies on buying and selling, getting you pre-approved for a home loan, getting you the best terms on that, and best strategies for putting together your total package, give us a call, shoot us a text, send us an email, check us out online. You can always check us out at mincolagroup.com or mincolahomes.com. You can email us at home@mincolagroup.com, or you can call or text us and reach Cynthia and I, all those ways, along with our main team line at 480-788-8569. Guys, have a great weekend and great rest of the week. We'll talk to you soon. Thanks.